Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. One of the things that I like to do is try to find companies that have a wide economic moat. What that means is some of these companies will have a pricing power, they might have a moat around their business, meaning nobody else can actually, or maybe not many companies can enter that market. That protects them from competitors, and of course they maintain their customers and so on. The other thing I like to do is, especially with the dividend paying companies, is try to find companies that are growing that dividend. It doesn't matter what the yield is right now to me. It could be 1%, but I'm looking for companies that will increase that dividend every single year. Some of these companies are called the dividend aristocrats, and these are companies that have increased that dividend for 25 years. Some companies are called dividend kings, which are companies that have increased for 50 plus years. And what I mean by that is they genuinely increased every single year. Sometimes it might be just something small, but they've increased it every single year for 50 years or 25 years in a row. And that's the type of business that you want to invest in. And the reason for that is because these companies have a growing revenue, they have a growing cash flow, and then they share some of that cash with their investors. They buy back their own shares. They are businesses that are very well run. Okay, and that's the type of business you want to invest. If I came to you today and I said to you, I have this business, you're going to ask me all these questions, right? So why don't we do that exactly same thing with the companies that we normally invest in? So I'm not saying I have all of those companies. Some of the companies that I own are genuinely for cash flow only. So what I want to do today is I want to share with you 10 companies that have a wide economic moat and they have increased that dividend basically the last 5 years 10% or more. Some of these companies have increased that dividend for basically they have a compound annual growth rate of 10 and up to 29%. So before we get to that, I just want to mention, as always, okay, if you can join us in the Patreon account, that would be really helpful to the channel. You get access to a lot of things that we share with you guys on daily basis. And at the same time, it will definitely help the channel. Of course, like the video if you haven't. There's almost about 50-something% of you guys that actually watch the videos that have not subscribed to the channel. And it would be absolutely amazing if you can like the videos as well. It doesn't cost a penny and it really helps the channel. Now, let's have a look at the 10 companies. So as always, we're looking for the same information that we normally look for. But today's focus is the moat around these companies, okay, like the competitive advantage kind of thing. And the dividend growth rate, the last 5 years, we're looking for companies that have 10 plus years, okay? Right, so the first company we're looking at today is Visa. Some of these companies, by the way, are undervalued at the moment. Some of them are not undervalued. As always, do your research as well. The first one is Visa. Like I said, 476 billion market cap. It has a wide economic moat right now, price of $234 per share. And they have just dividend yield of just below 1%. The payout ratio only 22%. Now this means they're out of their net income, so they just only spending about 22%, which means they can have they have room to improve that if they need to, and they are doing that. 20% latest increase, and the 5-year growth rate, okay, the dividend growth rate in the last 5 years is about 18%, which is absolutely huge. They have increased that dividend for 14 years in a row. They will give you $1.80 for every share of that company that you own. And the safety is 99%, which means 61% and above is safe. Okay, so 99% is the highest any company will get. Profit margin of 51%, return on equity 43%, return on invested capital of 27%. Free cash flow, they've got about $18 billion. Total return in the last 10 years, we're looking at about 17%. Next year, they expected the earnings to grow about 13% and then 14% after that. Right now, it's discounted. According to Morningstar, it's discounted about 3%, $241 per share is where they think the price should be. That's the first one. The next one is Texas Instrument, another company that's in the technology sector. They have 137 billion market cap, is wide economic moat. Price is about 150 right now. Dividend yield is actually 3.36%, which is absolutely high. 58% in terms of payout ratio, which is slightly high, okay? But latest increase basically was about 5%. The 5-year growth rate for the dividend is actually, the dividend growth rate the last 5 years is 17%. 19 years of increasing that. So another 6 years, this company will become a dividend aristocrat. Annual payout $5.20. Safety, we're looking at about 90%, profit margin 40%, return on equity, we're looking at 50%, return on invested capital 28%, free cash flow right now about $3 billion, total return in the last 10 years, we're looking at about 16%. Next year, they're expecting earnings to grow 7%, then 10% after that, 10% discounted right now, $116 per share is where they should be. This is really solid business, and one of the companies I looked at before I bought Qualcomm. But because I do have quite a few of the semis, I left this one out. But this is really good company. As right now, basically discounted 10%. Again, don't take my word for it. Do your own research, okay? UPS is the next one, 130 billion market cap. It has a wide economic moat, price right now $152 per share. The dividend yield is right now 4.24% right now, which is absolutely huge. Okay, 55% payout ratio. Latest increase was 6%. Let's call it 7%. The dividend growth rate in the last 5 years, we're looking at about 13%. This is the reason why I've included this company. It has 13 years of increase in that dividend, annual payout of $6.48, safety 69%, profit margin 13%, return on equity 40%, return on invested capital 12%, free cash flow of $6 billion, total return in the last 10 years 7.5%. Next year they're expecting the earnings to grow by 11%, then a little bit decline of basically 2%, discounted about 12% right now, $172 per share is where the price is at. Okay, I do own UPS, just to be transparent. The next one is Automatic Data Processing, another company that I own, 101 billion market cap. It has a wide economic moat. Right now is trading $243 per share, dividend yield of 2%, just above 2, payout ratio 58%, latest increase was 20%, and the dividend growth rate in the last 5 years is 14%. 49 years, so 1 more year this will become a dividend king. Payout ratio $5, safety 97%, profit margin right now we're looking about 19%, return on equity is 101%, return on invested capital 50%, free cash flow 3.6% right now, 14% total return in the last 10 years. Next year they're expecting the earnings to grow about 10%, then 13% after that, 1% basically discounted right now, $244 per share is where the price should be at right now. This is again another company that I've now added to my watch list, which I will be sharing with you guys, and I will be buying more of this company inshallah going forward. I'm hoping it comes back down again a little bit. I'll share with you guys in the next couple of days inshallah what I think. Next one is UPS and UNP, okay, Union Pacific Corporation. It was actually upgraded today. It was up a little bit. They reported the earnings. It wasn't actually that bad, but yeah, the company went up a little bit. 128 billion market cap. It has wide economic moat, $212 per share right now. Dividend yield of 2.5%. Payout ratio only 48%. And latest increase for some reason is not there. The dividend growth rate of 15%. The last 5 years. Last 5 years, yeah. Dividend streak of basically 65 years. Annual payout, we're looking at about $5.20. Safety, we're looking at 88%, profit margin 26%, return on equity, we're looking at about 50%, return on invested capital, we're looking at about 14%, 5.5 billion market free cash flow right now, total return in the last 10 years, we're looking at about 12%. Next year, they're expecting the earnings to grow about 12%, then 8%, 3% premium right now, $204 per share is where they think the price should be. Right now, it's about 212, so we will see where it goes. This company, I really like it. I think it's my second biggest company right now there. Tractor Supply is another company that we talked about a long time ago, 22 billion market cap right now, wide economic moat, price is almost to $200 per share, dividend yield is just above 2%, payout ratio 40%, 12 basically percent increase in the latest increase, 29% in the last 5 years. That's how much they've increased that dividend, which is absolutely huge. They've been doing that for 12 years. $4.12 is what you will get. 68% safety wise, 7.5% profit margin. Return on equity, we're looking at about 55%. Return on invested capital about 17%. They have $656 million right now free cash flow. Total return in the last 10 years, we're looking at about 12.5. Next year, they expected the earnings to grow 7%, then 7% after that for the following 5 years. 8% discount right now, $220 per share is where the price is right now. The next one is a company that I own in the portfolio again, is Broadcom, 358 billion market cap. It has wide economic moat, $861 per share right now, which is absolutely huge. I hope they split it, because they, again, with the fractional shares you can still buy it, but it makes it's better when it's actually you can buy a whole share in one go. I don't know, psychologically it's a bit crazy. Dividend yield 2%, just above 2%. Payout ratio 44%. Latest increase was 12%, and the 5-year growth rate in terms of dividend 29%, another 29%. Okay, they have increased that dividend for 12 years in a row, 18% right now in terms of payout ratio, and so the annual payout. Latest increase $18.40 of annual payout, which is huge. Safety right now we're looking at about 67%, profit margin 40%, return on equity we're looking at about 64%, 65%, return on invested capital 23%, $17 billion of cash flow right now. Total return in the last 10 years we're looking at about 37%. Basically next year they're expecting the earnings to grow 9%, then 11%, 6% premium right now. $815 per share is where the price is at. I wished I bought more of this company, honestly, when it was actually so cheap, and I've talked about it so many times, but I only managed to get 7 shares of this company. Next one is Mastercard. We all know this company, okay, similar to Visa, 365 billion market cap. It has wide economic moat, $386 per share right now. Dividend yield is just above 1%. Again, it's not about the yield, it's about the increases and so on. Latest increase was payout ratio, is about 20%. So they both have about 20% in terms of the payout ratio. The latest increase was 16%, and the dividend growth rate in the last 5 years, basically we're looking at about 18%. They're very, very similar when it comes to that sort of a thing. 11 years of increase in that. This one took 14 years, slightly more. Annual payout, we're looking at about $2.28. Safety 99%. Profit margin of 43%. Return on equity 175%. Return on invested capital of 53%. Free cash flow right now is 10%, 18%. Basically, let's call it 19% with total return in the last 10 years. Next year, they're expecting the earnings to grow about 19%, then 17% after that. Kind of more or less similar there. 4% discounted, 3% discounted. This one here, $406 per share is where their price should be according to Morningstar. Next company is Nike, 175 billion market cap, wide economic moat, over $100 per share right now. Basically in terms of dividends, 1.38, which is not huge, but is actually the increase that we're interested again. Payout ratio only 42%. Latest increase was 11%. The 5-year growth rate is basically 11%. 21 years of increase in that dividend. So 4 more years and it will become a dividend aristocrat. $1.36 basically is pence is where the cents is where the annual payout is right now, if I can talk. Safety 99%, profit margin is about 10%, return on equity about 34%. Now, in terms of return on invested capital, we're looking at about 20%, 4.46 billion of free cash flow right now. Total return in the last 10 years, we're looking at about 11%. Next year, they're expecting the earnings to grow about 17%. Then about 15%, 24% discounted, $136 per share is where the price should be. And finally, it's Accenture. Accenture is one of those companies that basically works with a lot of companies with from software side of things, consultants and so on. 190 billion market cap. It has wide economic moat, just below $300 per share right now in terms of price. 1.66% of dividend yield. Again, it's not huge, but they're increasing that dividend 41% in terms of the payout ratio. The latest increase was 15%. The 5-year growth rate about 11%, and the 18 years of increasing that dividend, $5.16 in terms of annual payout. Safety 92%, profit margin of almost 11%, return on equity of 29%, return on invested capital almost to 25%. Free cash flow right now over $9 billion, 16% total return in the last 10 years. 9% growth in terms of expected earnings to grow about 9%, then 9% after that. 23% premium right now, and I definitely agree with this because this was one of the companies I wanted to add to the family portfolio, but it's gone too expensive. I actually bought it and then sold it and then used that money for something else because it's gone up so much and I couldn't add it. So $247 per share right now. In term, basically that's where they expect the price to be right now, is all closer to $300 per share. Now there you have it. That's 10 different companies that have wide economic moat. They look like they have a good financials, and the dividend growth rate in the last 5 years is basically 10% or more. Now I'm going to show you the Sharia compliance side of things to just make sure. This is from Zoya, okay, and as you can see, all of them are absolutely fine. The only one that I would probably watch out for is UNP or Union Pacific, and that has about 28 interest bearing debt. The rest of them are absolutely fine. There's no issues there, and that's basically the data coming from Zoya. There you have it, 10 different companies, and of course I do own some of these companies. To be transparent very quickly, I do have automatic data processing. I do have Broadcom here. What else we talked about? And we do own Nike. What else? I think and Union Pacific. There we go. And Visa. Okay, so those are the companies that I own that we just talked about, just to be transparent with you guys. I hope that you enjoying this type of content, because what I'm trying to do here is not just to say, oh, go away and buy these companies. I'm just trying to say these are quality companies. Go away and do your own research, and if you agree, of course, then you do what you need to do. If you don't agree, of course, that's absolutely no problem. Some of you look in these companies and thinking it's definitely not cheap right now, and again, you might be right. Okay, like I said to you always, I mean, the information I'm using comes from Morningstar. I'm not doing discounted cash flow model myself. Okay, I don't have the time, I'll be honest with you. I don't. These predictions and the estimates are just too messy things, and I'm going to use the information that's provided. And of course, always have your margin of safety. We'll talk about that when we talk about the watch list, inshallah. But yeah, there are 10 different companies that are right now Sharia compliant, that are doing really well in terms of the dividend side of things. You have wide economic moat, and some of them are discounted. I hope you enjoy it. I hope you like the videos. Please, if you do, help us by just liking the videos, subscribing to the channel, of course, and join us on the Patreon account if you can, inshallah. Assalamu Alaikum.